It's 11 p.m. You open your investing app again. One stock is down 30%. It's been down for months. Your finger hovers over the sell button. And then you close the app. You've done this a dozen times. You can't click it. This isn't a discipline problem. It's not a knowledge problem. It's a wiring problem. One of the most documented glitches in the human brain. A study of 10,000 investment accounts caught it happening in the real world with real money. And the price of this glitch is bigger than you think. In 1998, economist Terence Odean got access to something rare, the complete trading records of 10,000 accounts at a major brokerage. Every buy, every sell. 6 years of real decisions. He asked one simple question. When investors sell, what do they sell? The rational answer shouldn't depend on the past at all, but that's not what the data showed. Investors were about 50% more likely to sell a winning stock than a losing one. They cashed out their gains and clung to their losses. Researchers call this the disposition effect. And here's the part that hurts. Odean tracked what happened next. The losers people kept went on to underperform the winners they sold by roughly 3.5% over the following year. People weren't just holding losers. They were holding the wrong stocks, systematically. So why does your brain do this? The answer starts with two psychologists, Daniel Kahneman and Amos Tversky. In 1979, they mapped how people actually feel about gains and losses. Not how economists said we should feel, how we actually feel. They found the map is lopsided. Losing $100 hurts about twice as much as winning $100 feels good. It's called loss aversion, and it's one of the most replicated findings in psychology. Now watch what this does to a losing stock. As long as you don't sell, your brain files it as a paper loss. Not real yet, still open, still fixable. The moment you click sell, the loss becomes final. Your brain treats that click as the moment the pain officially happens. So it does what brains do with pain. It avoids the click. Notice what's actually true, though. The money is already gone. The stock is worth what it's worth. Selling doesn't create the loss. It just makes you look at it. Your brain isn't protecting your money. It's protecting your feelings with your money. There's a second layer. Kahneman and Tversky found that when people are already down, they flip from cautious to reckless. Gamblers call it chasing losses. Researchers call it the break-even effect. Down 30%, your brain stops asking what's the best investment now. It asks one question: how do I get back to even? That number, your buying price, becomes magnetic. But here's the thing. The market doesn't know your buying price. The stock doesn't remember what you paid. Nobody does, except you. Getting back to even is a finish line that exists only in your head, and waiting for it can quietly eat years. A stock down 50% has to double just to break even. Your brain says, hold on. The math says that could take a decade. Two more forces pile on. The first is sunk cost. The longer you hold, the more the position feels like an investment of you, your research, your conviction, your identity as someone who picks well. Selling doesn't just feel like losing money. It feels like admitting you were wrong. The second is the endowment effect. In experiments, people demand about twice as much to give up an object as they'd pay to buy it. Simply owning something inflates its value in your mind. So the stock in your portfolio looks more promising to you than the same stock in someone else's. 4 biases, one direction. All of them whispering the same word: wait. What does the waiting cost? Go back to Odean's number, 3.5% a year on the money stuck in losers. Compound that over a decade of investing, and it's a real dent in your future. And there's an extra twist that proves this is emotion, not logic. In most countries, selling losers is the tax-smart move. Losses can offset your gains. If anything, you should sell losers more eagerly. Investors do the exact opposite for 11 months of the year. Only in December, when tax deadlines loom, does loser selling briefly spike. The rest of the year, feelings beat the tax code. That's how strong this pull is. So how do you beat wiring this old? You don't argue with it. You route around it. Quick pause. If this explains a decision you've been stuck on, a like genuinely helps this channel get found. Now, the fixes. Fix 1, the fresh money test. Ignore your buying price completely. Ask one question. If I had this money in cash today, would I buy this stock right now? If the answer is no, you're not really holding it. You're rebuying it every single day. You just don't feel the purchase. This one reframe deletes the break-even anchor. Fix 2. Write the exit before you enter. Decide in advance what would make you sell. A price, a broken thesis, a time limit. Written rules are made by the calm version of you. In-the-moment decisions are made by the version staring at red numbers at 11 p.m. Fix 3. Judge the portfolio, not the position. Kahneman called it narrow framing, feeling each stock as its own little win or loss. Zoom out. One losing position inside a growing portfolio isn't a failure. It's a line item. And fix 4. Automate what you can. Standing orders, automatic rebalancing, index funds, every decision you hand to a rule is a decision loss aversion can't touch. The best investors aren't fearless. They've just removed the moments where fear votes. Here's the reframe to leave with. Selling a loser isn't admitting failure. It's moving your money from where it was to where it works. The loss already happened. The only real question is what the money does next. Your brain will still flinch at the click. That's fine. It's supposed to. Flinch and click anyway. If you want more studies on how your brain handles money, subscribe. That's the channel now. And tell me in the comments, what's the longest you've held a loser? I'll read every answer.